The screen flashes green, the adrenaline spikes. A retail trader spots a massive momentum shift, executes the order, and watches the profit numbers roll up in real time. The execution is flawless. When the dust settles, the trader looks back at the setup to make sense of the windfall. They spot a moving average crossover. The relative strength index was hovering right where they thought it should be. The upward momentum, in retrospect, looks entirely obvious. This chart shows the exact peak they fixate on, a violent vertical price spike. Looking at this completed graph, the trader points to the exact bottom and convinces themselves they saw the geometry of the market perfectly aligning. That specific rationalization triggers a dangerous psychological leap. The trader stops viewing the profit as a byproduct of a fortunate statistical variance. Instead, they interpret the windfall as direct evidence of their own analytical genius. Feeling absolute certainty in a chaotic, probabilistic environment is a red flag. It is the first quiet symptom of a mindset that typically ends in total portfolio liquidation. The harsh reality is that the trader did not actually see that market move coming. They only think they did. Human memory is highly malleable. Behavioral psychologists call this biological glitch hindsight bias. Once your brain learns the final outcome of an event, it automatically reaches backward in time and rewrites your memory of the events leading up to it. During the actual trade, the investor felt ambiguity, hesitation, and fear. The data was mixed, but the moment the trade closes in profit, the brain scrubs away the memory of that anxiety. It leaves behind a clean, sanitized narrative where the path to success was perfectly clear all along. Operating in the market based on that corrupted memory sets a lethal trap. The trader begins to base their future risk parameters on a past level of still that never actually existed. To understand how dangerous this trap is, we have to wind the clock back to the exact second before that successful trade was executed. Backtesting a strategy on a completed chart suffers from look-ahead bias. The shape of the trend is already visible on the right side of the screen. You already know how the story ends, which makes the analysis mathematically flawed. This visual represents the true point-in-time reality of the trader. The right side is a black void. The leading price action is a stuttering, formless blur of market noise. There is no trend. There is only raw, immediate volatility. Add standard technical indicators, and the noise amplifies. The moving averages overlap, separate, and cross back over each other. Buy signals flash and disappear within seconds. The data directly contradicts itself. The trader's current retroactive certainty is an illusion. At that specific historical moment, the market was delivering objective, mathematical randomness. Pressing the buy button in that exact second was a gamble. It was an action taken without any reliable mathematical proof of what would happen next. If the reality of the market is that random, why does the human brain fight so hard to impose order on it? We instinctively invent patterns out of pure noise. Researchers like Daniel Kahneman dismantled the old economic theory of the purely rational investor. They proved that humans have a deep biological need for narrative structure. We are deeply uncomfortable with chaos. That discomfort breeds the illusion of control. When an investor flips a coin and it lands on heads, their brain desperately wants to attribute that outcome to their own technique in flipping the coin, rather than to physics and probability. This illusion transforms the trader's perception of the market. They stop seeing it as a fluid landscape of shifting probabilities. They start treating it as a solved puzzle. Relying on that false narrative is a mathematical death sentence. You can survive a chaotic market once through luck, but luck cannot be systematically scaled. Let's follow that same trader into their next setup. They approach the terminal armed with a massive surge of confidence, entirely fueled by their hindsight rewired memory. They succumb to action bias. The psychological urge to replicate their previous feeling of genius pushes them to execute. They force a trade in a low-quality setup because sitting in cash feels like wasting their supposed talent. Then comes the fatal escalation. Because they falsely believe they know what the market will do, they deploy extreme leverage. They widen their stop losses, they disable the safety nets. The market abruptly reverses. The leveraged position rapidly bleeds margin. The broker's automated risk systems kick in, violently liquidating the trader's entire account in seconds. The psychological collapse is immediate. The trader's carefully constructed narrative of control shatters against an objective, unforgiving reality. The ultimate irony of the wiped-out account is the origin of the failure. The initial euphoric win was the exact psychological catalyst that engineered the catastrophic loss. Surviving long-term requires a specific defense mechanism. Professional traders operate by totally divorcing their personal ego from the outcome of any single trade. They use point-in-time journaling. They record their thesis, their doubts, and their exact risk parameters before they execute. The logic is locked in before the price action can corrupt their memory. Professional trading relies heavily on systemic risk management. It treats the market as a game of probabilities, completely abandoning the mystical idea that an individual can predict the future. You have to explicitly acknowledge the role of luck in your wins. If you don't, the market will eventually find the flaws in your logic, and it will expose them without mercy.